Hi, I'm Larry Repko, CEO of the Valmark Financial Group. At the beginning of 2022, I did a post on LinkedIn where I predicted the collapse of the IUL premium finance market. I'd like to give you an update on that 15 months later after that prediction. And here's what we're seeing today. A number of the programs that we are reviewing where clients have borrowed significant money from commercial banks are in deep trouble. I'm going to talk a little bit about the new regulation of revised AG 49A, some call it AG 49B, as it pertains to index universal life illustrations. Finally, I'm going to address the prevalence of fake indexes and a little bit of what's going on there, both in terms of performance and the AG 49B regulation. So let's first look at existing financial plans. We're reviewing about 15 in-force premium financed IUL programs in-house. And I can say universally, all of them appear to be in a very deep hole. And the requirement for additional collateral caused by a flat or down market has clients asking questions about these. Now, what's causing the problem? What I've been reading, writing, and recording videos about now for over several years is just the unrealistic assumptions that go into these index universal life products. And these programs are basically on a very unsolid or completely unstable foundation. And what are some of those things? Well, these illustrations have consistently overstated what clients would get. There have been now 3 regulatory attempts to correct this. What we're also seeing is borrowing rates for that money from the bank. The rates are going through the roof, at least in terms of what was originally projected. Almost every policy in force has seen a 0. And finally, the most unstable part of it all index universal life illustrations are based on a 45% options profit. That means when the company sets the cap, it's based on them returning a 45% options. That has been the compromise from the beginning and something that we have long called for regulators to change. Well, what's happened since these products have come out? Well, the caps have fallen universally across products, across companies. I'd like to give you a real world example of what that looks like for a specific client who started borrowing in 2017 when the illustrated rate was 7 and the cap was well above 11%. It also showed the borrowing continuing for almost 20 years, all at a 4% rate. Well, fast forward to 2023, the cap has dropped to 7.5%, which means less than a 5% illustrated rate, and the cost of borrowing has gone up to 6.25%. Now, if we look at a realistic crediting rate going forward, even if the client thought the S&P 500 would do 10%, we're still looking at something less than 5%. That's because dividends are not included in an index product. Back to why existing plans are in such a hole and why the outlay that this client was shown is now triple what it was originally. It's because we did have a declining equity market, which meant that the segment, instead of returning the 7% linear projection, had a 0. This causes additional collateral to be required for this specific plan. As we look going forward, some of these programs are going to experience 2 years of 0 in a row. Now, at the same time, loan rates have escalated from that 4% or 3.5% rate to above 6%. This has spiked collateral calls. Now, as clients uncover this and realize the extent of the financial damage and how it will just get deeper and deeper, a number of them have brought litigation against the carriers, against agents, and even against banks. If you have one of these, what should you do? You have to get a second opinion, and not by the person who sold it to you. Um, we've seen a number of people who've sold these programs that say, oh, this is just temporary. The cap rates are going to go back up, or borrowing rates are going to go down. We've even seen written projections with this. Seneca said, be wary of the man who urges no action in which he himself incurs no risks. These are big stakes. Clients who were shown a small outlay are now facing the prospect of having to repay loans with millions of dollars pledged with collateral. We have a tool at Valmark that we've created with our member firms called the Premium Finance Analyzer. No one should have a risk management program that multiplies their financial risks. And working with somebody who really understands this and can objectively tell you what your options are is the best course. The member firms of Valmark take seriously the cause of helping real people solve real problems with real solutions then work. To us, that's what it means to bring the golden rule to life. I hope you found this helpful today.